Good evening, students. Welcome to the session. Yes, good evening, everyone. Have you revised and solved the sums that I had given you in the last lecture? I hope you have done that. Yes. So shall we start with this? I'll first quickly revise. Since not many students were present for the last lecture, I'll quickly recap what we have done for the benefit of everyone. So after MAT, we had started with the topic of tonnage taxation that we had discussed in much detail. But since that's a very simpler topic, you can just go through the video, which is available on YouTube as well. And possibly you can just go through the module also on that. It's a very, very simple topic, the tonnage taxation, just that you have to remember the slabs. Secondly, you have to remember that it has to contribute 20% to the reserve, right? And then we discussed about the something called as the alternate minimum taxes. So I said that the alternate minimum taxes are not applicable on the book profit, but on the net profit, which is computed as per the provisions of the Act. In that, you will add back the Chapter 6A deductions in relation to the profit linked deductions which are there, which is ATIA, ATIB, all of those, other than Section 80P. And then you will also add back the deduction under Section 10AA, and then you will add back the deduction under Section 35AD, less the depreciation on the capital asset of the 35AD on which you have claimed the 35AD, as if the 35AD would not have been claimed. So a notional depreciation. And the AMT will be applicable when the adjusted total income. So this is going to be your adjusted total income after adding these three category of income. If it exceeds rupees 20 lakh, then AMT at the rate of 18.5% will be applicable. So AMT is 18.5%, whereas MAT is 15%. So, and then in the case of IFSC unit, the AMT as well as the MAT will be 9%. So then in that case, if that exceeds your normal tax liability, so then you'll pay as per the AMT, but you will also get the refund of, you will get the AMT credit as well, right? You will get the AMT credit for 15 years, which you can utilize against the normal tax provisions whenever you pay for that, which will be the computation of the AMT credit will be very similar to the MAT credit, that the differential amount between the normal tax and the MAT, your normal tax and the AMT will be available to you as the credit to be claimed in the next year, right? And then there is a similar provision for the restriction of the AMT credit against the foreign tax credit. So that is very much similar. Then AMT is not applicable in case you go for the optional scheme for the cooperative society in the 115 BAD, BAE, or for the individuals if it is not opting out of 115 BAC scheme, then the AMT will not be applicable, right? So that was about the AMT, and all the normal provisions of the Act will be applicable, like 234BC for the AMT as well will become applicable. Good evening, Viraj. Good evening, Shankara. Okay, so with that in mind, we will start with the sum that I had given you for the AMT. So first we'll deal with that question and then we will move forward. So Mr. Roy was engaged in the business of cold storage and he had earned the net profit of rupees 105 lakh during the previous year 23-24. Following particulars are given in relation to his business. So he incurred the capital expenditure of rupees 190 lakh on purchase of land and building during the period Jan 23 to March. He has capitalized the amount in the books as on 1st April 23. Cost of the land is 120 lakh out of the amount of 190 lakh. He also incurred the capital expenditure of 45 lakh for extension or reconstruction of building purchased. The profits from the cold storage has the following bifurcation. During the year, he has also earned some salary of rupees 20 lakh for managing the cold storage. He has also contributed to LIC tax saving FD amounting to 1 lakh, medical premium of wife for 20,000, and he has a self-occupied property which he had taken on loan. The interest on loan is 3 lakh. Then the storage of the agricultural produce is eligible for 35 AD. So 35 AD can be claimed for food grains and for sugar. Storage of edible oil is not eligible for 35 AD. So yes, what will you do in this case? Let's start with this question. Yes, students. Have you solved this question? Yes or no? What will be the answer? Quickly solve it. I'm waiting for your answers. So we'll start with the profits from the specified business, food grains, sugar, right? First, we'll compute the 3580 deduction, isn't it? Yes, students. Good evening, Geeta. Good evening, Namrata. So how we will start? Yes. So we'll start simultaneously. First, we'll compute the 3580 deduction. Let's try and first compute the 3580 deduction. Let us start simultaneously. Yes. I think it just got restarted. 1 second. Yeah. Okay. So we'll start with it. So first will be computation for computation of deduction under section 3580. So we have food grains and sugar. For food grains, what is the net profit that we have to start with? 60 lakh, and this is 14 lakhs, isn't it? So 60 lakh and 14 lakh is the net profit. Then secondly, what you would do? Yes, what will be the deduction? So first is the expenditure in relation to the business, the capital expenditure of 190 lakhs. Whether that you will get or will you not get? Yes. So the expenditure on the capital which has been there. So capital expenditure of 80 lakh and for the food grains and 60 lakh for the sugar. Will you get that? Yes, students. Faster. Section 3580 we have already done in the PGBP chapter. Yes, students, I'm not getting any of your answers. Faster. 80 lakh for food grain, 100% deductible. Namrata? No, the answer is not correct. Namrata, go back to your 3580 notes. Geeta, no, the question itself says that the food grain and sugar both are eligible for 35 AD. So then why you will not get any deduction for 35 AD? The question itself is saying. So students, if you remember for section 35 AD, I had told you what is allowed as the deduction. So if you go back to your specified deductions, which I had given you under PGBP, sector specific. If you remember there, we had discussed about 35 AD. Yes. So 35 AD, 100% of the capital expenditure, which is wholly and exclusively for specified business, is allowed as deduction under 35 AD, except land, goodwill, or financial instrument. So the land is not allowed as the deduction under section 35 AD. Yes, students. So you will not get for the land. So here, in this particular question, what will happen is, so this is for food grains. So less deduction for capital expenditure. Now the capital expenditure which has been incurred prior to the business commencement will also be allowed if it is capitalized in the books of account as on the date of commencement of business. So expenditure prior to the commencement of business, if capitalized in the books of accounts as on the date of commencement of business, will also be available to you. So therefore, in that situation, you will get the deduction of the expenditure which has been incurred prior to that as well. Are we getting that? So if you look at the question, it says the expenditure which has been there of 190 lakh was in the previous year, Jan 23 to March 23. It is not from April 23 onwards. It is of the prior year. But it has been capitalized as on 1/4/2023. So therefore, we will get that, but we will exclude the amount of the land expenditure. So 80 minus 50 lakh, 30 lakh is allowed. This is prior to the commencement as capitalized. And for the sugar, it is 60 lakh minus 40 lakh. This is 20. Then less deduction for the capital expenditure during the previous year, 23-24. So 20 lakh, then 15 lakh. Right? So this is incurred during the year. So 100% of that will be allowed. So 60 minus 30 minus 20. This is 10 lakh. And then 14 lakh minus 20 lakh minus 15 lakh. This is loss of 21 lakh. Isn't it? So whether loss of 21 lakh will be allowed to you? Yes, students. There's a 10 lakh of profit. There is 21 lakh of loss. So what will you do? Yes. Yes, students, faster. What will happen to the loss? You were supposed to solve this question and come for the class. You have not solved this question and nobody is answering as well. See, I can write the solution in a 5 minutes and I can just close this particular topic as well. But then you will not have any practice and that will not make any sense to you. So if you are not going to answer, I can just close this topic, but you will not understand when you will do by yourself. It will defeat the entire purpose of having the practice in the class. If you are not revising and coming for the class, it is no use, students. You have to revise and sit for the class. If you have forgotten the set off and carry forward chapter, you can go back and look at it. But please answer. Yes, Geeta, specified business loss can be set off against the specified business income. So here, what I will do is I will set it off this particular loss against the specified business income itself. So my total deduction is this much, but then I will be having a loss. So 11 lakh carry forward to next AYs. For how many AYs I can carry forward? For how many AYs I can carry forward the loss? And can I set it off against any other business income? Yes. Can I set it off against any other business income? And for how many years I can carry forward and set off the losses of the specified business? Yes. Faster. How many years? Specified business loss. Yes, correct, Mohammed. It can be only set off against the specified business income. It cannot be set off against any other business income, right? So if you look at the section 73B of the losses, this can be carried forward indefinitely. You are correct, Shankara. Namrata, it is not 8 years. It can be carried forward indefinitely. Mohammed, not 4 years. Sandhya, not 8 years. Yes, Geeta, you are correct. It is infinite years. So make mistakes. That is fine. But you have to correct yourself in your notebook where you're writing. Just put a red mark and write it is indefinite. Yes, Shankara, very good. No time limit, but the ROI should be filed before the due date under 139.1. So yes, an additional point to you, Shankara, in case you also mention that the ROI should be filed before the due date under 139.1. Very good. So you can write down that it is available indefinitely. So this is the set off and carry forward chapter that we had done. And this is what the assessment of various entities will test you on several grounds. Indefinitely. Yes. Okay. So now I'll compute my normal income. So now I'll put the computation of the total income. Okay. So first of all, I have the some income as salary income, which is 20 lakh for managing the cold storage. So I will consider the salary of 20 lakh less the standard deduction of 50,000. So 20 lakh minus 50,000. This is giving me 19.50 lakh. Then I have loss under IFHP, which is 3 lakh. So entire 3 lakhs will be allowed to me as a loss. Yes, what about IFHP? Entire 3 lakhs will be allowed to me as loss. It is in context of the self-occupied property. Yes, students. Yes, Namrata, you need to revise, but this is how is the revision pattern to be followed. You cannot revise everything in isolation. You will not remember. You have to keep revising through the sums itself. Okay, Namrata? Yes, Mohammed, correct. Yes, Namrata, it is 2 lakhs. Yes, correct. It is restricted to 2 lakhs. So the loss under the house property, this will be restricted to 2 lakhs. Okay. Then you have the PGBP. So you have profit from the edible oil. So total profits you have is how much? 31 lakhs. Right? Out of this, how much will you set it off? Yes. How much will you set off? How much will you claim any kind of expenditure? You will claim the expenditure as the depreciation on the building. Assuming this net profit is without considering the depreciation on the building, you have purchased a building which is 50 lakh, right? Out of that, the land is not a depreciable asset. So that you will minus. So on 20 lakhs, you will carry out the depreciation. So less depreciation on building 20 lakh into 10%. This is 2 lakh, right? So on 20 lakh, which is there. And then, of course, you also had some repairs which are carried out to the building during the current year. So you have 31 lakh, no, not the 31 lakh, 10 lakh during the current year also. So we don't need to forget that. So this should be 20 lakh of the last year plus 10 lakh of current year into 10%. So this is going to be 3 lakh. So this is 31 minus 3. This is 28 lakh. Is this fine? So now 28 lakh is my PGBP. Fine. Now gross total income comes to, yes, so my GTI comes to 28 lakh plus 19.5 lakh minus 2 lakh, 45.5 lakh. Right? Out of this, less chapter 6A deduction. So under that, I have under chapter 6A deduction, ATC. How much is the ATC they have given? 1 lakh, and medical premium is 20,000 ATD. So 1 lakh and 20,000. ATD is 20,000. So 1.2 lakh. This is 44.3 lakh. Right? Now this is what? This is Mr. Roy. So he's an individual. So now you will calculate the tax for him. Right? You will calculate the depreciation number. That's simple. The depreciation is basically the 20 lakh, which is for the last year, which is the land and building minus the cost of the land, and 10 lakh, which is incurred for the current year. Okay, Namrata? So these two are the depreciation. On that, I have calculated the 10% depreciation. We are assuming the net profit is without any depreciation, Namrata. So if you look at it, this is the depreciation on. So this 50 lakh, which was there for the edible oil, out of that, I have subtracted 30 lakh for the land. And this is 10 lakh, which has been a capital expenditure during the year. So this makes it the 30 lakh as the building cost. Okay, now how will you come to the tax rate calculation? What will be the tax rate calculation? Yes. Yes, students. What will be the tax rate calculation? Let me see who gives me the answer. Yes. What will be the tax rate? Slab rate, I understand, Geeta, but under which section? Yes, Geeta. Yes, students. How will you calculate the tax? Do you remember the sum in the mat? Yes, Geeta, correct. So then if I'm going with 115 BAC, is this computation what I've made is in alignment with 115 BAC, Geeta? Is this the computation that I've made as per section 115 BAC? Do you remember the sum in the mat where we had calculated the normal tax at the rate of 25% or 30%? And then we had applied the mat as well. And then, of course, we had also gone into the optional scheme of 115 BAB 15% to compare which one is beneficial. Sandhya, not as per 115 BAC. Why not as per 115 BAC? Namrata, you have gone as per the old tax regime, yes. So here also what we are going to do, here I have made an option to opt out of 115 BAC to see if I can claim 35AD deduction and I have a beneficial tax rate. And then what I will do is, if that be the case, then AMT also will be applicable to me, right? So I will first calculate the tax by opting out of the 115 BAC because as I told you, 115 BAC is now a mandatory regime. Is not an optional regime unless you opt out for it, right? So you have to opt out to go for 35 deduction. So what I'll do is I'll make a computation as per 115 BAC. I'll make a computation without as per 115 BAC as per the normal provision. And on that, I will also apply the MAT because MAT is not applicable on 115 BAC. So then I will take a position as to which one is beneficial, isn't it? So this is as per the normal provision. This particular option that I have put in over here is as per the normal provision, right? Isn't it? So now tell me, what is the tax that is coming to you as per the normal provision? And you can write over here at the top, computation of total income as per the optional regime. This is the optional regime. Now, the normal provisions are the optional regime and not the mandatory. You have to opt out. Opted out of section 115 BAC. Okay, so what will be my tax liability on 44.3 lakh? Tax as per optional regime is it coming 11,87,160 by any chance? Yes, students, 11,87,160. Yes, correct, Rita. All of you, are you getting this much tax amount? Yes. Yes, Sandhya, you cannot take under 115 BAC chapter 60 deduction, but I am not computing as per 115 BAC. I am going as per the optional regime to see if it is beneficial to go under optional regime and claim 35 AD, claim chapter 60, or then I will compute as per 115 BAC to see if that is more beneficial. Yes. Are you getting this much tax? Correct? Yes, Geeta? Okay. Now, in this particular case, if you look at the adjusted total income needs to be computed. Because if you're claiming section 35 AD deduction, the math will also become applicable to you. Now, under math, you have to start with your total income, which is 44,30,000. Right? Now, in that case, computation of AMT. So I have to start with my total income, which is 44.3 lakh plus chapter 6A deduction part C, which is pertaining to the deduction in respect of income. Is there any chapter 6A in respect of income? This is not applicable. Not all chapter 6A needs to be added. Only those which are claimed in relation to the income, which is ATIA to section ATRRB. Plus section 10AA deduction. Is there any 10AA deduction? Answer is no. Then plus section 35 AD deduction minus the notional depreciation. Now, what is section 35 AD deduction that I have claimed? So, if you look at it, the section 35 AD deduction is total of this plus this. So, this was 30 lakh plus 20 lakh. This is 50 lakh, right? And this is 35 lakh. So, deduction under section 35 AD was 85 lakh. Deduction under section 35 AD was 85 lakh. So, 85 lakh minus 10% depreciation on 85 lakh. Because this is in relation to the building only, right? This entire capital expenditure is on building. So I have to consider the notional depreciation on that, which will be 8.5 lakh, isn't it? So this will be 85 minus 8.5 lakh. 76.5 lakh needs to be added back. So my adjusted total income will be 120.8 lakh. 120.8 lakh. Since this is more than 20 lakh, AMT applicable. So AMT at the rate of 18.5%, which is 22.348 lakh. So my AMT will be 22.348 lakhs. Isn't it? Now in the AMT, if you look at it, my total income, my adjusted total income is more than 1 CR, which is 1 crore 20 lakh 80,000. So I will also have the applicability of surcharge. Since my total income is exceeding 1 CR but is less than 2 CR, I will have the surcharge at the rate of 15% plus the cess at the rate of 4%, making my effective AMT was 8.87, 26.728. This is my AMT. Now, what is my tax as per the optional regime? 11 lakh 87. What is the AMT that I am getting? 26.2728. So I will have to pay as per the AMT. I will have to pay as per the AMT. So 26.728 minus 11 lakh 87,160. So there will be AMT credit, which will be 1485660. This will be my AMT credit to be carried forward for 15 AYs, just like the MAT credit. So this is step 1. Now the step 2 is you compute the tax. So computation of total income as per default tax regime under section 115 BAC. Fine. So in this, I will have salary, which is 20 lakh. Will I get the standard deduction under 115 BAC? Yes. Do we get the standard deduction under 115 BAC? Yes, students. Under 115 BAC, do we get the standard deduction or not? For the individuals, yes, Pastor. Yes. Yes, Namrata, we do get. Geeta, we do get the standard deduction. If you remember, under the basic concepts class, I had written it with the red words. Standard deduction is allowed even under 115 BAC. So here you will get the standard deduction. So less standard deduction. This has been an amendment which has been introduced. So 19.50 lakh. What about the loss from the house property? Will you get any loss from the house property under the self-occupied property under the 115 BAC? Yes. Loss from the house property, is it available? Yes, Geeta, the house property loss is not allowed. So you're correct. So loss from SOP is not allowed. Then what shall be my PGBP? Total profits. What will be my total profits which will be taxable over here? Yes. Mohammed, house property losses from self-occupied property are not allowed. Yes, Geeta, correct. 35AD income deduction will not be allowed. Yes, Namrata, let out is allowed, but the loss from let out also is not allowed. Only you can have the inter-source set off. You cannot have the inter-head adjustment. You cannot set it off against any other head of income. Yes, what will be my PGBP? What will be the total net profits which will be taxable over here? So total profits over here are how much? So yes, 60 lakh, 14 lakhs and 31 lakhs. All three will be added together. So 60, 14 and 31 because here you will not get 35 AD deduction. So 105 lakhs. Then depreciation on building will be allowed. So there's no prohibition on depreciation, only additional depreciation is not allowed. So the entire building is how much? The building has been, the capital expenditure on building is 190 lakhs, out of which the land cost will be removed. So land cost is 120 lakh, which is for the prior year. And then 45 lakhs is the expenditure for current year, which is 115 lakh. Right? So 115 lakh into 10%. So 11.5 lakh is my depreciation. So which will give me 93.5. The total income will be 19.5 plus 93.5, 113 lakh. Less chapter 6A deduction, this will be not applicable. So my total income is 113 lakhs. Okay. My total income is 113 lakh. Now, tax under section 115 BAC. What shall be the tax under section 115 BAC? Yes. What will be the tax under 115 BAC? Yes, what shall be the tax? Yes, students. Yes, up to 3 lakh it is nil. But what shall be the total tax liability? Calculate for me, please. 30,90,000. Yes, please confirm whether you're getting 30,90,000 as a tax liability. Yes, please confirm to me. Yes, students, are you getting this answer? So if you're getting this answer, then if you look at it, it is beneficial to go as per the normal provisions, because even with the MAT, my tax liability was somewhere close to 22 lakhs. So it is not beneficial to opt in for 115 BAC. So it is beneficial to opt out of 115 BAC. So you can write it over here. It is beneficial to opt out of section 115 BAC. Yes or no? Any questions, any doubts, students? Are we clear up to this? Shall we proceed further? We have to solve one more question on the AOP and BOI. Yes, perfect, Shankara. Okay. And then after this, we had done the partnership taxation, which was nothing but the revision of the partnership profits. How do we tax that? So I had told you there you will get the share of profit is exempt, remuneration and interest is taxable under 28(5), and it is allowed as deduction under 40B up to the limits. Interest is up 12%. That we've already seen under 40B. Then to get assessed as partnership firm as such, you should have instrument and the shares of partners should be specified. Then we also talked about set off of the losses on the change in the constitution of the firm. What is change in the constitution? It means the change happening in the firm due to the retirement or the death of the partner, not due to change in the profit sharing ratio. So to the extent of the outgoing partner, the share of his losses will not be allowed to be carried forward by the firm. These losses will not include the unabsorbed depreciation. And then I told you that the liability of the partner is joint and several. Is joint and several. And in case of the succession, the separate assessment has to be made on the old and the new firm. And in case of change in constitution, the assessment has to be made on the reconstituted firm, which is the partners which are existing as on the date of the assessment. Right? And then, of course, the conversion of company into LLP, that is exempt, that we have seen under 47 section. And then we have also seen section 9B and 45(4), which is in respect of the partnership, right? Then we move towards the AOP and BOI, which I said that the under AOP and BOI, which is there, it is assessed as same as individual, which is you have the default tax regime as 115 BAC and the optional is the normal tax. And interest and remuneration is not allowed as deduction. That we have discussed under section 40BA while we were doing the PGBP. Now, only exception is interest paid in personal capacity or paid on behalf of other person. Okay. Now, computation of tax, if the shares of the members is known and if any member has other income greater than the basic exemption limit, and in that case, it is to be taxed at AOP to be taxed at MMR. And if any member has the tax rate higher than MMR, then the portion of that member to be taxed at that higher rate and the balance income to be taxed at MMR. But in both the cases, AOP is to be taxed and the share will be exempt in the hands of the member under 86. And on that, we had seen the MAT. This is to be excluded from the book profits while calculating the MAT, right? any income or the expenditure in relation to that particular income. We had seen how the MMR is the maximum marginal rate as applicable to the individual at the highest slab of income, even the surcharge, right? And in case the no member has other income greater than basic exemption limit, then the AOP is to be taxed as per section 115 BAC as default regime or normal tax regime, but the member's share will be included in his income under section 67A and the rebate will be given under 110. So how the formula is for that? So first you will compute the share of the income from of the member from AOP or BOI excluding any interest remuneration. Then that you will apportion under different heads of income in the same manner in which the AOP or BOI's income is determined. Then you will add back the interest and remuneration, and any interest on loan taken for the investment in AOP is also allowed. That will give you the total income of the member. Then tax on the total income, you will find out the average rate of tax and that you will apply on the share of the member to get the rebate under 110. And in case the share of the members are unknown, then if no member is taxed at MMR at a rate higher than MMR, then AOP is to be taxed at MMR. In case any member is taxed at rate greater than MMR, then the total income of the AOP is to be charged at that higher tax rate. But the share of the member will be exempt under 86 and that will also be excluded from the book profit. Right? So we'll solve a question on this. Okay. Also, in case the AOP has only companies as member, the highest surcharge will be the 15%. Okay. So, JK and Associates is an AOP consisting of two members, J aged 40 years and K aged 37 years. Shares of the members are 60 and 40%. So, it is known. Income of the AOP for the previous year is 11 lakh. J and K's other than income from AOP amounts to 2.5 lakh and 2.9 lakh. Compute the tax liability of the AOP, assuming that the J exercises the option to shift out of 115 BAC regime and the AOP and its member K pay the tax under the default tax regime under 115 BAC. Yes. So let's start with the computation. How will you start with it? Yes. Yes, faster. This is very simple question. First of all, whether shares are specified, what will be the tax rate, what can you think about this? Yes, students. Just now giving you the chart. Yes. So in this case, if you look at the chart above, what did I say? That the shares of the member are known, 60 and 40. Now, whether any member has income greater than the basic exemption limit other than the share from AOP or BOI. So you do not need to consider the share of the AOP or BOI while determining the basic exemption limit if that income is more than the basic exemption limit. So for that, you need to see which regime you are opting in because the slabs are different under the two regimes. For J, he is going as per the normal provisions, and for K, he is going as per the 115 BAC. So for J, it does not exceed 2.5 lakh. And for K, what is the basic exemption limit? Yes. it is 3 lakh, right? So none of the members have income exceeding the basic exemption limit, excluding the income from the AOP. So then in that case, the AOP would be taxed at the rates applicable to an individual under the provision which it wants to adopt, right? So either it can go as per 115 BAC or the normal tax regime. Now here it has selected the option of going as per the 115 BAC. The K pays tax and the AOP pays tax as per section 115 BAC. So therefore the AOP's tax liability will be, so you can write here, since none of the members have total income other than share of AOP greater than the basic exemption limit, AOP shall pay tax as per the section 115 BAC, since it has not exercised option to opt out of section 115 BAC. Okay. So what is the income of the AOP? Total income of AOP is 11 lakh. Now on the 11 lakh, calculate the tax. Yes. How much you're getting? 75,000. Yes. So the total income, the tax is tax under section 115 BAC is 75K plus set at the rate of 4%. So this will give me 78,000. Are we clear? So tax is 78,000. Now total income of J and K. So share of AOP. What is the share in AOP? So in 11 lakhs, 60% is of J, which is 6.6 lakh, and 40% is of K, so 4.4 lakh, plus other income, which is 2.5 lakh and 2.9 lakh, right? So what is my total income? So 6.6 plus 2.5 is 9.1 lakh, and then 4.4 plus 2.9, 7.3 lakh. Isn't it? Now the tax liability. So this is under normal and this is under 115 BAC. Right? So tax in normal regime, 9,10,000. $94,500, right? And for K, it is 7,30,000. So this comes to 28,000. Then cess at the rate of 4%, 29,120. This is 98,280, right? Then what will be my rebate? First, I will calculate the average rate of tax. Okay, what is the average rate of tax? So average rate will be 98,280 divided by total income of 9,10,000. So 10.8%. In the case of K, it is 3.99%. Okay. So rebate under section 110. So 98,280 on that. So this is 6.6 lakh into 10.8%. So 71,280, and this will be 4.4 lakh into 3.99%, 17,556. So my total tax in this case will be 27,000, and in this case it will be 11,564. Yes, students, is this clear? How Geeta other income is more than basic exemption limit? Geeta K is opting for 115 BAC. For 115 BAC, the basic exemption limit is 3 lakh and not 2,50,000. Are we clear? Yes, so did you understand how do we compute the income for the AOP and its members? Yes, students. Any questions, any doubt? Yes. Just go through it for 1 minute before we proceed further. Okay, perfect. Okay. Let's proceed further then. Now we are moving towards the last topic, which is there, okay, which is the cooperative society, which is also what we have done in the last class. If you remember, I talked about section ATP, the tax rate is slab rate, and you have an optional scheme under 115 BAD and 115 BAE. For the ATP, there are different set of deductions which are available, okay, that we have spoken, and then there is for the producer company under ATPA. Okay. And then as told you, member of the housing society is deemed to be the owner and not that cooperative society. Now we are going to speak about the concept of the mutuality. We have already done that as well as a part of PGBP. So if you remember the PGBP, I had spoken about this concept of mutuality when we were talking about section 28. Does anybody recollect? What is the concept of mutuality? Yes. Do you recollect that? See, we have already done that in very much detail at the time of PGBP itself. But it's given as a part of this chapter, so I'm just, reflecting back for you, and then there are certain case laws in relation to that, so that we have to deal with once before we take the break. So the concept of mutuality is in cases where, let's say, for example, the clubs, the associations, the cooperative societies are formed basically to help the members itself. Okay. So the mutuality principle says that no person can trade with himself or make the profits out of one own self. So one cannot earn the profits from one own self. So which means what? That whatever surplus that I'm generating out of the services which are provided to the members itself is not considered as the taxable surplus. So what does that mean? So I will be collecting the contributions from my members and I will be spending for the benefit of my members. For example, the entrance fees, the maintenance charges which are collected by the cooperative society, the membership charges of the gym which are collected. So see, I'm collecting the membership charges for the gym and then I am providing the equipments to the members so that they can access the facility of the gym. Let's say, for example, I'm collecting the membership charges for a club, and then I'm providing you the swimming pool, the clubhouse, and everything else. So it is basically for the benefit of you only. Similarly, the maintenance amount which the housing societies collect. Now, again, that is to be used for all the services provided to the members which are living in that society. For example, gardening, for example, security, lift for other amenities, whatever. So even if some surplus remains, that surplus is not taxable because it is to be considered for the benefit. So mutual association is basically where a group or the association is coming together with the common objective and contributing monies for achieving that common objective, and where the surplus which is earned will also be used in future for the members itself. So the particular cardinal principle to the mutuality is that all the contributors will be similar to the all the participator in surplus. The contributors and the participator, the beneficiaries of the surplus are one and the same. If that is not the case, if the contributors are different from the beneficiaries, then the mutuality principle will not be applicable. So there has to be complete identity between the contributors and the participator. Only then one can say then the mutuality principle is applicable, that one is earning the profits for one own self itself. Okay. So it could be the surplus which is earned today, but it may be utilized for in the future. It may not happen immediately, but it could happen in the future year as well. So it will not make a difference whether this association is in the form of cooperative society, a partnership firm, or a company, whatever, but it should be the owners, the parties, the contributors and the participators should remain the same. Only the participators, the owners should be taking the advantage of that particular contribution and nobody else. Okay. So that is the concept of mutuality. So there has to be the identification between the contributors and the participators. Okay. Now, where a mutual concern is a trade, professional, or similar association, and it is providing the general services to all the members, then that surplus will be exempt. It will not be taxable. It will be exempt on the basis of the principle of mutuality and not on the basis of any particular section under the Income Tax Act. It is a principle as per which it is exempt. However, let's say, for example, where I'm providing a specific service to a member. So I am, let's say, for example, collecting the charges. For example, giving the hall on rent to the member. Let's say there's some wedding which is happening. Let's say there's some birthday party which is happening, for which I am letting out my hall and I'm collecting the charges for the usage of that hall. Then that will be taxable under section 28(3) of the Income Tax Act. So that is a specific service for which the income is collected, that is provided to a specific member, that shall be taxable under section 28(3) of the Act. So the objective is that if any surplus is arising from specific services rendered to the members, then it will not be governed by the principle of the mutuality. Are we clear? So basically that is against the principle of mutuality, because the contributor and the participators are not one and the same. Okay, in that particular case. So what will be the income which will be taxable? Of course, the profits will be taxable and not the only gross receipts. It says income. So income means the gross receipts minus the expenditure income. So that will be taxable under 28(3). Now, what about the losses which is arising for the general services which are provided? So let's say, for example, the income is exempt under the principle of mutuality in case the contributors and the participators are same. But if the losses are arising, if the deficiency is arising, then in that particular case, what was the provision? Anybody remembers? Yes. So section 44A provides for the deduction. So in case there is deficiency arising on the provision of the general services, which ideally should not be allowed, but a specific provision is being created which says if the expenses are greater than amount received, the revenue expenditure, not the capital expenditure on the general services like the entrance fee, maintenance, all of that, then the deficiency is allowed as the deduction, which is being restricted to half of the total income. So the maximum limit is 50%. And this can be set off against any other head of income. Okay. So this can be set off against any other head of income. Are we clear? So the opinion is that any surplus accruing to the members from the any surplus which is accruing to these associations would not be taxable, but any deficiency which is there, that will be allowed as the deduction under 44A. Are we clear? Yes or no? Yes or no? So now there are certain case laws on this particular point that I would like to discuss with you, which are part of your module. Okay. Now that we are almost done with this particular chapter, before we go on to the break, there are certain case laws that I would like to touch upon here in detail. Okay. Now, as I said, there has to be the identity in terms of that who is earning, who is contributing, and who is basically being beneficiary of that particular contribution, right? So there has to be the identity in relation to the same. Okay. So now in that particular case, let's say for example, that there is a club which is there. There is a club which is there. Now in that club, let's say for example, the contributors which are there, they are contributing in relation to the club, the membership charges. Okay. So what will be the implication? So let's say, for example, there's a transfer fee which is paid by the cooperative housing society members. Now this transfer fees which is there, which is received by the cooperative housing society from its incoming and outgoing members, will it be exempt on the grounds of mutuality? Now, the cooperative society, the housing societies basically, they charge the transfer fees when the flats in the society are transferred. So, the Bombay High Court in this case had held that this is also not liable to tax on the grounds of mutuality. It will be governed by the mutuality, since the cooperative society's basic purpose is to maintain the cooperative society. Here, it is not earned with a commerciality. It is not earned with the commercial mindset that I have to make profits, therefore I am charging the transfer fee. Okay. So basically this transfer fee which is charged only to Basically, avoid the kind of any kind of damages to the society in terms of the building flats which are getting transferred. So this is also the participators and the contributors are the same in this case, and therefore here will be it will be exempt. What about interest earned on the surplus funds of a club deposited with the banks? Whether mutuality will be applicable. So let's say, for example, a club is there, it has deposited the amount into the bank and it is earning the interest. Whether it will be governed by mutuality. Yes. Yes, students. Faster. What do you think whether interest which is received by the club will be governed by the principle of mutuality? Yes or no? Yes, yes, Geeta, you are correct. So basically, the interest which is earned, that is not there for the that will not be governed by the principle of mutuality. So the interest which is earned, that will not be governed by the principle of the mutuality. For the reason that is earned with the principle of commerciality. That is earned with the principle of the commerciality. Are we getting that? So that will be not allowed here. So that will be specifically taxable. Now, whether it will be taxable in other sources or PGBP? Yes. Whether that shall be taxable in other sources or the PGBP? Yes, students. Faster. It will be taxable under other sources and not under PGBP. This shall be taxable in other sources because under PGBP under 28(3), the income which is taxable is the income from services to the members and not the interest. Okay, so here you can write down. You can write down transfer fees as well for the mutuality are covered. Interest on fixed deposit not covered by mutuality, taxable under income from other sources. Taxable under income from other sources. Okay. Similarly, there are non-occupancy charges charged by the society, common amenity charges. So all of that are basically covered by the principle of the mutuality. Fine. Any questions? Any doubt? Yes, Namrata. Yes, Geeta, you are correct. Okay. Now, two more case laws that I would like to deal. So basically, that is again a part of your module where it says that there was a land which was inherited by three brothers. Okay, they had inherited the land from their father. Now that is being compulsorily acquired by the state government. Now the capital gain which is arising on that land, whether that would be assessed as the AOP or would be assessed in their individual capacity. So three brothers inherited a property from their father. Now that was compulsorily acquired by the state government. So capital gain arises under which section? Yes. First of all, which section the capital gain arises? Yes. The capital gain arises under which section? On the compulsory acquisition of the land 45(5)(a), which says that the capital gain shall be chargeable to tax not in the year of acquisition, but in the year when the first compensation is received. You remember section 45(5)(a) of capital gains, right? So here the department was trying to assert that this should be assessed as AOP's income because the three brothers had inherited the land and therefore the department said that this is like AOP. So this income should be taxed as AOP's income and not in their individual names. So the Supreme Court in that case held that no, this will not be the AOP's income. AOP will be when the individuals are coming together to earn the profit with a common action or the concentrated action which is being on their part. Here it is acquired by the government. Okay. Now it is not on their own will that they are coming together to sell this land. Had it that been the case, one could have said that this could be AOP. But here the basic fundamental of the AOP is missing. That all of three have not come together to earn the profit. And therefore, this would not be assessed in the status of the AOP. This shall not be assessed in the status of the AOP. Are we clear? Yes or no? Did you understand this case? Yes or no? Okay. Any questions? Any doubt till now? Yes, students. Yes or no? Yes or no, students? Okay. So see, if it is sold voluntarily, Mohammed, then in that case, one can say that they are coming together to do the business. Then there is AOP constitution. But if they are just selling it to dispose of that property, even then the AOP will not be there. Are we clear? Okay, last one case law, which is again very important. For the purposes of the MAT, let's say, for example, under MAT, there is the capital gain income which is included in book profit. Let's say there's a capital gain income which is included in book profit. Now, the question before the Supreme Court, before the Madras High Court was that can one claim 54 EC against that capital gain? So, we are paying the tax as per MAT. Okay, we are paying the tax as per MAT, but under MAT, under the book profit, there is a capital gain. Let's say on the sale of the long-term capital asset, on any long-term capital asset. Now, can I claim section 54 EC against the book profit, which includes the capital gain? The Madras High Court said yes, you can claim the 54 EC exemption even against the book profit, which includes the MAT, which includes the capital gain. Are we clear? So that is the last case law that I wanted to discuss with you. Now, under this chapter, there is also section 115 BBF, which is the 10% on the royalty income on the patents developed and registered in India. That also we have done already, that particular tax we have done. So under 115 BBF, if you remember, I told you 10% on the gross basis we have to charge. Under the MAT only we have done that. So that also tax we have already done it. There's one more tax on the transfer of carbon credits. Now, what are carbon credits? Carbon credits are basically incentives given to the industrial undertaking for reduction of the emission of greenhouse gases. So, if they reduce the emission of the greenhouse gases, they are entitled to a certified emission reduction certificate. They get a certificate. Now, this certificate they can trade. They can give this certificate to anybody else. So the holder of that certificate can transfer it to any other entity which needs the carbon credits to overcome their unfavorable position. So it can be, this kind of certificate shows that whether you are in positive or negative in terms of greenhouse gas emission. So if you're in negative, then you need the credits to basically emit the greenhouse up to a certain limit. So if you transfer the carbon credit which is there, then the income therefrom will be taxable at the rate of 10% on gross basis. So that's a limited income that is there. And then other than that, we have ADR and GDR's income under this particular chapter, but that we shall deal when we will go to the international tax class. Okay. So with this, we are completing this topic, and now we will start with the trust taxation after the break. So let's take a small break of 10 minutes and then we get back. Okay. Let's take a break of 10 minutes. Students, let's proceed with the new topic. Write down taxation of trust. Let's write the new topic. The taxation of trust. Now, under this topic, students, under the taxation of the trust, we are going to have different categories of the trust that we are going to cover. Okay, so what are the trusts that we are going to cover? Just write down taxation of trust. First is the charitable or the religious trust. That also we have under the two regimes. One is section 1023C and another one is section 12A. Right? Then the private trust. Then we have the private trust. Then the third one that we have is the political parties. Fine. Then we have the securitization trust. Then we have the alternate investment AIFs. And then finally we have real estate investment trust and the InvITs. Okay, so these are the trusts that we are going to cover under this particular regime. Fine. Now the trust, first of all, my question to you is, students, whether trust is a person at the first place. Whether trust is covered under the definition of the person. Yes, students. This is very important topic. The question, a direct question on this can be expected in the examination. Whether the trust is a person at the first place. My question to you. Yes. Yes, Geeta, correct. What about the others? Whether trust is a person or not. Yes, students, faster. Yes. So trust, students, is not a person. Understand that thing very, very carefully. Trust is not a person at all. So under the definition of person under section 231, the trust is not a person. Are we clear? So trust is not considered as a person. So then if trust is not considered as a person, then what is it considered like? So how the taxability works for that? Yes, students. How the taxability will work for the trust? Yes, students, any answers faster? How will we compute the taxability for the trust? Yes. So for that, we need to look into the kind of trust it is. The kind of trust which it is. Based on that, we need to decide the taxability. So first we are going to start with the securitization trust and the REITs and the InvIT. You're not going to start with the first charitable trust because that's a very large topic. And today we will have like 1 hour which is remaining with us, 1.5 hour. So we will not start with the charitable trust because tomorrow we will come in like in the day after we will cover the charitable trust. But for now, we are not going to touch upon the charitable trust and the private trust. So we are first going to touch upon the the InvITs, REITs, and the securitization trust. So that is what we are going to target first. Now, what are securitization trust? First, we'll start with that. Anyone has idea? What is a securitization trust? Yes, any idea regarding that? Yes, students. Yes, students. Anybody knows what is a securitization trust? Okay, let's understand it very, very carefully. Now, these are the trusts which are functioning for the purposes of the specific uh, provisions which are there. Okay, so these trusts which are there, these are some working for some specific provision by which they are governed. Now, what is that specific provision? So let's write here first about the securitization trust. Yes, write down the securitization trust. Now I'll explain you with the example so that you understand what are these trusts and how are these operating in basically. So in case of the securitization trust which is there, the securitization trust which is there, these trusts which are operating, they are operating for a specific purpose, as I told you. Now, what is the specific purpose that these are operating for? Let's understand with the help of an example. Okay, I will explain once again, yes, the principle of mutuality before the end of the class. I will explain once more. Do not worry. But first, we'll talk now about the securitization trust. So let's say, for example, there is a borrower who is borrowing the loans from the bank. Borrower borrowing the loans from the bank or the financial institution. Fine. There's a borrower who is borrowing the loan from the bank or the financial institution. Now, this loan will be given only against some charge on the assets. So, he's pledging the secured assets to the bank against which he's getting the loan. Now, usually, what happens is the bank, in order to avoid any default, what they do is they give the assets, they pledge the assets to the securitization trust. Now, let's assume there is one securitization trust which is there, to which the bank will pledge the assets, and this will give the funding to the bank. So this securitization trust which is there, this will give the funding to the bank. So securitization trusts which are operating, they are operating for a specific purpose. So as I said, this specific purpose which is there, that is in relation to the assets which are being held. So these are the trust which are special purpose entity, the SPV, special purpose vehicle, which are set up in order to take the assets which have been pledged by the bank and give the funding in relation to the same. So these are basically the securitization trust. Now, in case of the securitization trust, the taxation which is there is governed in a different manner. So as I told you, that these trust basically converts the pool of loan into a securitized debt. So they act as a SPV for transferring the financial assets of the originator to the investors based on which they generate the money. Now this securitization trust which will be there, now this securitization trust will have the funding from the investors. So it will have the funding from the investors. So it will issue the security receipts. It will issue the security receipts. Now, what kind of income it will get? It will receive the interest from the bank on the amount that it have funded, and at the same time it will pay interest to the investors, right? So it will have income by way of interest from bank or the financial institution, and on the funding that they have obtained, they will pay interest to the investors. Isn't it? Yes, Geeta, you were correct. It's a separate, it's a pooling of funds for specific object. Yes, Mansha. Yes, Mohammed, NSDL. Yes, that's correct. So this is basically a securitization is a mechanism which is basically used by the banks, by the NBFCs, by the financial institutions to basically ring fence or prevent them from bankruptcy. So they create an asset pool in return for immediate cash payments. So it is an effective method which is used by the banks, NBFCs, housing finance company to cash on the illiquid assets. So by pledging the assets, they will get the funding immediately in order to enable the financing of future activities at an economic cost of funds. Okay. So that is the securitization trust. Now, how does the taxability works for the securitization trust? That is something we will have to understand. Now, the income of the trust will be exempt under section 1023DA. So, income exempt under section 1023D. These are basically the pass-through entities. These are the pass-through entities. Now, what do we mean by pass-through entities? Pass-through entities or the transparent entities as we may call them. That means the income is not taxable in their own hands because they are first of all not considered as person. They are not considered as person. So the income will be taxed in the hands of the investors. Are we getting that? The income is taxed in the hands of the investor in the like manner and to the same extent as it would have been taxable in the hands of trust. So section 115 TCA. Section 115 TCA provides that any income accruing or arising to the investor from the securitization trust out of the investments made in the securitization trust shall be taxable in the hands of the investor in the same manner as if the investor had made the investment directly in the underlying assets. So, income taxable in the hands of investor in the like manner and to the same extent as in the hands of trust. Fine. That is section 115 TCA. So the income, what does that mean? Will be deemed to be the income in the same nature and in the same proportion as it was arising in the hands of securitization trust. Let's say, for example, if securitization trust has business income, has some other sources of income. So whatever the proportion which will be distributed to the investor, now in the hands of the investor, let's say the income which is distributed, that shall be bifurcated in those two heads only in the same proportion as the income was arising in the hands of the securitization trust. Are we getting that? So that is the meaning of the same manner and to the like extent. Now the securitized, how will the investor come to know that what is the nature of the income in the hands of the trust and in what proportion it is chargeable under different heads in the hands of the trust. So the securitization trust has to provide the breakup by providing a statement to the investor that this is how your income will be taxed under different heads of income. Are we getting that? Now, when the securitization trust is paying to the investors, when it is paying to the investors, the interest amount, okay, so then in that particular case, the TDS will arise under section 194 LBC. So here there will be TDS under section 194 LBC. Now, for the resident individual or the HUF, it shall be 25%. For the other than resident others, it shall be 30%, the rate of TDS. And for the non-resident and the foreign companies, it shall be at the rates in force. What do you mean by rates in force? The rates in force basically means that the rate provided under the Act or the rate under the DTAA, whichever is beneficial, that shall be your rates in force. Okay, so rates in force means rate under the Act or the DTAA, whichever is beneficial. Are we clear? So any income which is distributed to the investors, that will be taxable in this particular manner. So this is the limited aspect that you have to know about the securitization trust. Any questions, any doubt about the securitization trust? Yes, students, is this clear? This is about the securitization trust. Shall we move towards the AIF, Alternate Investment Fund? Okay. Okay. So then we have the AIFs. The second one is the Alternate Investment Funds, AIF. Now, what are these alternate investment funds? Now, these alternate investment funds are basically of two categories, category 1 and category 2 AIF. Now, what are these AIFs basically? Now, AIFs which are there, these are the investment vehicle that collects the funds from the large investors which are there. From the large investors which are there, they could be foreign, they could be Indian, for investing in accordance with the SEBI's policy. So what do AIFs do? AIFs are regulated by SEBI. They are registered as AIFs. They are not mutual funds, right? So AIFs basically are the investment vehicle for the high net worth individual who collect the investments from the high net worth individual, family offices, institutional investors, and they offer different classes of assets for making the investment. So these invest in assets that are not typically available through the traditional investments. Now they are registered either as trust, they are registered sometimes as LLPs or even companies. Now here we are looking at when they are registered as trust. Okay, so they are basically the investment vehicle. It is like a mutual fund, but mutual fund invest in the share market, right? Or in debt securities, right? So these are not like traditional mutual funds. They are very, very specialized investments that there are the fund managers which are sitting. They are very specialized investment. They may be investing in real estate. They may be investing in not real estate, of course. They may be investing in certain asset classes like startups. They would be investing in some of the unlisted, some of the convertible debentures, like different asset classes they invest into. Now, basically, when you're investing in AIF, there are two types of AIF. One is category 1, second is category 2. The category 1 AIF accept the investment from venture capital fund, the small and medium enterprises, from the infrastructure funds, and the category 2 AIFs are basically the real estate funds which invest in properties and generate the income through rentals, capital appreciation, the private equity funds which invest in the private companies, the debt funds, and there are also the category 3 AIFs which have now been not there much, like the hedge funds and the commodity fund. So here the people who invest is basically the high net worth individual. Okay, so category 1 are the venture capital or the SME funds which are there. Okay, now in terms of the AIFs, how the taxability works. How the taxability works in terms of the AIF. Let's understand that. Now again, the AIFs, if they have two set, we will bifurcate it in the two set of income. You can write down. So if they have the PGBP income, and then if they have the other income other than PGBP. So the taxability of the AIF. PGBP income, the other income. Now, in case the income is other than the PGBP, in case the income is other than the PGBP, then in that particular case, the income shall be taxable in the hands of the investment fund. And if it is PGBP, then this shall be exempt at the fund level and will be taxable in the hands of the unit holder. So for the PGBP income, AIFs shall be passed through. Okay, so here exempt in the hands of AIF. Here it will be exempt in the hands of AIF under section 1023 FBB. And in the case of other income, this shall be taxable in the hands of the AIF. This shall be taxable in the hands of the AIF. So in case of PGBP income, if it is exempt in the hands of the AIF, okay. So if it is a PGBP income which is arising under the head PGBP, so income accruing or arising, which is received by the unit holder of the investment fund, which is the proportion of the income which is of the same nature as the income chargeable under the head PGBP at the investment fund level, shall be exempt under 2023 FPP. So this implies that the investment fund is taxable in the hands, all the income of the investment fund is taxable in the hands of the unit holders except the income under the head PGBP. Sorry, I have written it over here incorrectly. So this should be other income and not PGBP. Okay. The PGBP is taxable in the hands of AIF. So if this is exempt in the hands of the AIF, this shall be taxable in the hands of the unit holder. So if it is other income, this is going to be taxed in the hands of the unit holder in the same manner and to the like extent. In the same manner and to the like extent. So this is about the AIF, unit holder, taxable in the hands of unit holder. Now, what about the income which is there, which is in the nature of PGBP, which is taxable in the hands of the AIF? So that income will be exempt in the hands of the unit holder. Okay, that will be exempt in the hands of the unit holder. So any other income is taxable in the hands of the unit holder in the same manner and the like extent. In the same manner and in the like extent. Are we clear? Now there will be the TDS in respect of the income which is paid to the unit holder. So the AIF is required to deduct the TDS on any income other than the PGBP income which is payable by the AIF to the unit holder. So in that particular case, TDS will be there under section 194 LBB. Now, in the case of resident unit holder, it shall be 10%. In case of the resident unit holder, it shall be 10%. And in the case of the non-resident unit holder, it shall be at the rates in force. We saw what is the meaning of rates in force, which is rate under the Act or the rate under the DTL, whichever is beneficial. Whichever is beneficial. Okay. Now, what about the tax rate which is there for the PGBP income in the hands of the AIF? Now, if the AIF is incorporated as a company or a firm, if the AIF is a company or a firm, then the tax rate shall be the 30% or 25% for company and 30% for the firm. Right? And if it is, so you can write like this. For company, this is 30 or 25%. For firm, this is 30%. And for others, it shall be the MMR. For firm, for other than company or firm, it shall be the MMR. Are we clear? So in case the income is under PGBP, it is taxable in the hands of the AIF and exempt in the hands of unit holder. In case it is other than PGBP, then it will be exempt in the hands of AIF. It will be taxable in the hands of the unit holder in the like manner and to the same extent. And the TDS will be 10% in case of resident, in case of non-resident at rates in force. Now there is one more important aspect. Here also, how do we get to know as to in what proportion, like the securitization trust in the hands of the unit holder, the other income will be chargeable in the same head only. But how the unit holder will get to know? So AIF has to furnish a statement. Also, AIF has to mandatorily file its return of income under section 139(4)(f). So in that particular case, it has to file the return of income mandatorily by the due date. Now, what if there is a loss under the AIF? What if there is a loss under the head AIF? So in that particular case, if there is loss under the head PGBP, which is incurred by the investment fund. So since the income is taxable in the hands of the fund and not in the hands of the unit holder, the loss is to be carried forward and set off at the fund level. It will not be passed on to the investor. So you can write down losses for the PGBP income to be carried forward and set off at the fund level. Now, what if there is other loss which has arisen? So we understand that there could be loss for the current year, which is chargeable under the head PGBP. Now, this will not be allowed to the investors. This will be carried forward and set off at the fund level. How about the loss other than the loss under the PGBP? Now, this loss, which is there, here you need to see what is the period of holding of the investment. What is the period of holding? If the units are held for at least 12 months, then it cannot be carried forward by the fund, but the unit holder can carry forward and set off the losses if the units are held for more than 12 months. Okay, so if the units are held by the investors for at least a period of 12 months, then the loss will be set off by the unit holder. Are we clear? So basically you can write down over here for other income, if units held for greater than equal to 12 months, losses allowed to be carried forward and set off by the unit holders. Firm cannot set off. Okay. Now, what if the losses which are there are not arising in respect of the less than 12 months, units held for less than 12 months? So in that case, what do we need to do? In that case, the act is silent. Whether the investment fund can carry forward those losses. Because certainly those losses cannot be carried forward by the investors. But the act is silent in respect of the allowability in the hands of the investment fund. So you can write down, if units held for less than 12 months, then, sorry, losses cannot be set off and carry forward by the investors. Act silent with regard to allowability of losses to the fund. Okay. And any other losses which are there, that can only be carried forward by the unit holder and not by the fund. Are we clear? Any questions? Yes, any questions, any doubt? Shall we solve a question on this? Mohammed, I already gave the answer. If it is less than 12 months, the act is silent. Of course, the investor cannot set it off. Okay? Okay, so let's solve a question on that. So from your module, one question on this particular point I'm putting across. Following are the particulars of the income of four investments fund A, B, C, D. The business income is given, capital gain is given, and income from other sources is given. Compute the total income of investment funds and each unit holder for AY 24-25, assuming that each investment fund has 20 unit holders, each having one unit held by them for a period exceeding 12 months. Income from the investment in the investment fund is the only income of the unit holder. If the fund C has the following income components for 25-26, what would be the total income of the fund and the unit holder for that year? Business income, capital gain, and income from other sources is given. So we'll compute one by one. First, you'll tell me for A, what will be the taxable income for the fund A? Yes, students. What shall be the income of fund A? Mohammed, this is the example in the module. This is the illustration which is forming part of the module. Nineteen illustration. Geeta, no. So the business income of the fund is nil because it is not there. Now the 20 lakh which is there, the 20 lakh, the capital gain and other sources which is there, that is not going to be the income of the fund. That will not be the taxable income. Of course, it's the income of the fund, but that will be treated as a pass-through income, right? That will be treated as a pass-through income. So that will be taxable in the hands of the unit holder in the like manner and to the same extent. Now, if you read, it says there are 20 unit holders and each one is holding one unit. Are we clear? So if 20 lakh is there as the total income of all the unit holders, for one unit holder, this will be 20 lakh divided by 20 unit holders. So 1 lakh will be the income. So in the hands of the unit holder, so for fund, this fund, or I'll write it over here, not taxable, then for unit holder, this shall be 20 lakh divided by 20. So this will be 1 lakh. Now this will be taxable in the proportion of capital gain and income from other sources, which is 4 is to 1. Right? Which is 4 is to 1. So 40,000 80,000 will be taxable here and 20,000 will be taxable in income from other sources. Are we getting that? Now what about B? B has a business income of 2 lakhs and the capital gains which is there. Yes, Geeta, you were correct. What about the fund B? Yes, Geeta. So in the case of B, business income will be 2 lakh, which will be taxable in the hands of B. And for the unit holder, this shall be 18 lakh divided by 20. So 18 divided by 20 is 90K each. Now this will be in the ratio of, again, the capital gain and income from other sources in the ratio of 7 is to 2, right? So it shall be 70,000 and 10,000. So in the like manner and to the same extent. Are we clear? So the income of the fund B would be chargeable to tax at 30% if it is a firm, or at the rate of 30% or 25% if it is company, and maximum marginal rate in any other case. And in the hands of the unit holders, it will be taxable in the like manner and to the same extent. Okay. Now what about the fund C? What about the fund C? Yes, Mohammed, the loss will be allowed, but which loss? The PGBP or the capital loss? Yes, students. How the losses will be allowed, we just now discussed. Yes, Mohammed, other loss. So the business loss will be allowed to the firm. So this 2 lakh will be allowed to the fund, and this balance 6 lakh which is there, which is a capital loss. Now can this be set off against the other sources? Yes. Can this be set off against the other sources? The answer to that is no. So the income which is distributed to the unit holder is 2 lakh rupees divided by 20 lakh. Sorry, divided by 20, not lakh. So this is how much? The income which is distributed to the unit holder is the 8 lakh. Sorry, not 2 lakh. It is 8 lakh. Right? Now this 8 lakh divided by 20. This is 40,000 which is to allow to the per investor. Are we getting that? So in the case of the fund C, the business loss of 2 lakh is set off against the income from other sources, which is 8 lakh. Okay. So if you look at it, the capital gain cannot be set off against other sources, but the business loss can be set off against the other sources. So the income which will be distributed will be 8 minus 2 lakh, 6 lakh. So here it should be 6 lakh, which is 8 minus 2 lakh. Okay, divided by 20. So this will be 30,000 as income from other sources. And the 6 lakh, which is there as capital gain, this will be the 30,000 set off allowed in next AYs or in succeeding AYs. So the same can be carried forward by the unit holder since the units are held for a period of 12 months or more. Are we clear? As units held for greater than 12 months. Okay. If it would have been less than 12 months, then he would not have been allowed to carry forward that particular set off of the losses. Are we clear? Yes or no? But while you are distributing the income, you will distribute after setting off the business loss. The capital loss, any which ways, cannot be set off against the other source. Now it says if the investment fund C has the following income components for AY 25-26, what would be the total income? Now against the business income of 2 lakh in the next year, right? Now this business income of 2 lakh, since you have already set off against the income from other sources in the current year. So then this business income of 2 lakh will not be set it off by the fund in the next year. Are we getting that? So the fund has already set off this particular 2 lakh against income from other sources as interhead. Right? So again, in the next AY, you will not get 2 lakhs. You are not carrying forward the 2 lakhs. You are setting off against the income from other sources. So in AY 25-26, this 2 lakhs shall be taxable in the hands of fund. However, in case of the 9 lakh, which is there as capital gain. So 9 lakh divided by 20, which is 45,000 minus 30,000, 15,000 taxable for the unit holder. So this will be taxable in the hands of the unit holder. Are we clear? Because we have brought forward capital loss of 30,000. And then there will be other sources So this is again divided by 20. So sorry. This 20,000 again taxable in the hands of unit holder. Now in the case of Fund D, the business income is of 5 lakh. The business income is of 5 lakh. However, there is the income from other sources as well, which is a loss. In the case of Fund D, so therefore the loss from other sources will be set off against the income from the business. So this shall be set off. Similarly, in this case, this is first set off. So first you will do the interhead adjustment, and the loss which remains after the interhead adjustment, that shall be carried forward either at the level of fund or at the level of unit holder. Are we getting that point? So here only the 3 lakh remains. Now this 3 lakh will be taxable in the hands of the fund. This 3 lakh will be taxable in the hands of the fund. In the hands of the unit holder, we will have 1 lakh as capital gain. There will no other sources. Okay? Yes or no? Yes, students? Yes or no? Any questions? Any doubt? Geeta Fund C loss, yes, 2 lakh, and each investor's income 40,000. There will not be any income, Geeta. There is only one income which is there in Fund C, which is 30,000 income from other sources, which is remaining as the other sources. Not 40,000, it shall be 30,000. And 30,000 will be the loss carry forward. Yes or no? Is AIF pretty clear to everyone? I'm giving you 1 minute time to go through it. Now, after this, we will not start REIT because REIT is again going to take some time. So what I'm going to do is we are going to start with the taxation of the private trust and the political parties. Okay, so we are not going to start with the REIT because REIT, as I said, will take certain time. So I'm not going to start with that. Because REIT, we will do it tomorrow or whenever we have the next class. So that we are going to deal after the charitable trust, or first we'll complete REIT, of course, and then we'll start with the charitable trust. But for now, we will start with the private trust. Okay. Yes. So now in case of the private trust, which is there. Now the private trust can be of 2 types. Okay. So just write down taxation of private trust. Now, the trust which are there, the private trust which are there, in fact, can be of 2 types. Revocable and irrevocable. What do we understand by a revocable trust? You have already done that as a part of your clubbing income. Clubbing of income chapter, yes. You would have done the revocable and irrevocable trust. What is revocable trust? Yes, students. Yes, you would have already done through the revocable trust, meaning of revocable transfer of assets, section 61. This is covered under section 61 of the Act. Yes, 61, 62, 63. So irrevocable and revocable, 61 or 60 to 63. So a transfer shall be deemed to be revocable if it contains any provision, if it contains any provision it contains any provision for the retransfer the income or the assets to the transferor, either directly or indirectly. So if any transfer has been made, but it contains a provision for the retransfer of assets or the income to the transferor, that is a revocable trust. Retransfer directly or indirectly assets or the income to the transferor. Secondly, if it gives the transferor the right to reassume the power directly or indirectly over the income or assets. So basically, where the transferor of the asset has retained the power over the income or the assets that he has transferred to the trust, or it has any provision in the agreement while transferring that he will get back the assets or the income, that is a revocable trust under section 63. Right? Now, in the case of trust, there are three parties. One is the settlor. The settlor transfers the asset to the trust. For the benefit of the beneficiaries. So, transfers the asset for the benefit of beneficiaries. Okay? Sorry. And this trust is managed by the trustee. Now, let's say, for example, when the settlor transfers the assets, but it is not for the benefit of beneficiaries, but for his own benefit. So, he has a right to reassume the power over the assets. Or he is transferring to the trust to be transferred to transfer the assets back to him after a certain point of time. That is a revocable trust. And in the case of a revocable trust, as per section 61, as per section 61 of the Income Tax Act, in the case of revocable transfer of assets, the income shall be taxable in the hands of the transferor. So, income taxable in the hands of the transferor or the settlor. Fine, it shall not be taxable in the hands of the trust. What about the irrevocable transfer of assets? So where the assets are transferred to the trust, such that, this is section 61, such that this trust is not revocable during the lifetime of the beneficiary or any transferee. Then and the transferor derives no direct or indirect benefit from such income, then this shall not be taxable in the hands of the settlor. Okay, so basically, irrevocable trust is, section 62 says, if the transferor does not derive any benefit, if the transfer derives no benefit directly or indirectly, that is A. And secondly, the trust is not revocable during the lifetime of the beneficiary, then income is not taxable in the hands of settlor. The income is not taxable in the hands of the settlor. Okay. Now, one more very important part. Now, as I said, when the settlor transfers the asset for the benefit of the beneficiaries, in that particular case, whether any capital gain will arise, to the settlor. Yes. So when the settlor transfers the asset to the trust, assuming it's not a revocable transfer, it's an irrevocable transfer. Then in that case, if you remember, I had told you under section 47, any transfer of a capital asset under the irrevocable trust is not regarded as transfer. So this shall not be regarded as transfer under section 47. This shall not be regarded as transfer under section 47 if it is irrevocable trust. So this is not regarded as transfer under section 47. So therefore, no capital gains. There will not be any capital gains in the hands of the settlor. Are we clear? There is one more important point over here. As I told you, when the assets are transferred to the trust, and when the beneficiaries are recipient of that particular asset. Now, when the assets which are transferred to the trust, right, in the hands of the settlor, there will not be any capital gain. But in the hands of the trust, whether there will be 56 to 10. What was 56 to 10? 56 to 10 was basically the receipt of the asset for inadequate or without consideration. So here the trust is not paying any consideration. So can one say that 56 to 10 will be applicable over here? Yes. So if you remember, we have done 56 to 10 gift taxation. There I had told you that this will be not regarded as the applicable for 56 to 10. So 56 to 10 will not be applicable if the trust has been created for the benefit of the relative. So 56(2)(10) will not be applicable if the trust has been created for the benefit of the relative. Are we clear? So you can write down, neither the capital gains will be applicable over here, nor at the same time 56(2)(10) will be applicable. Clear? So just write down over here. Just write down, no 56(2)(10). If assets received for benefit of relative beneficiary. Okay, if the assets are received for the benefit of the relative beneficiary. Yes, any questions, any doubt till now? Is this clear? Yes or no? Okay. Now understand, in case of irrevocable trust, how the taxability will function. Now again, the irrevocable trust can be of two types. One is specific, another is the discretionary trust. Okay. So another is the discretionary trust. There are two types of trust. Also, one more important point over here, in case of the clubbing of income, before we move further. If the transfer is made to a trust for the benefit of the spouse or for the benefit of daughter-in-law, then the income will be clubbed in the hands of the settlor. So you can write here, if the transfer to the trust for the benefit of spouse or the daughter-in-law, then this shall be clubbed under section 64. This shall be clubbed under section 64. Now for the irrevocable trust, again of two kinds, specific trust and then the discretionary trust. Now the specific trust is basically where the shares of the beneficiaries are determinable. If the shares of the beneficiaries are determinable. Now if there is no business income, then in that particular case, if there is no business income, then in that case, share of the beneficiary taxable in the hands of beneficiary at the slab rates. This will be taxable in the hands of the beneficiary at the slab rate. This is as per section 161. And if there is a business income, this will be taxable at the rate of the MMR. This shall be taxable at the MMR. Business income taxable at the maximum marginal. So this is under section 161. Are we clear? So in the case when the shares of the beneficiaries are determinable. So in that case, the representative assessee. Now who is a representative assessee? Now the representative assessee means that the trust is not a person, right? A trust is not a person. So somebody has to be elected as a representative assessee who will represent the trust for the purpose of the collection of the taxes. So in case of the trustee is appointed under a trust and he will be treated as the representative assessee. He will be treated as a representative assessee. Are we clear? So then the taxes will be collected from that particular person. Clear? So in respect of income, which a trustee appointed under a trust receives or is entitled to receive on behalf of the beneficiaries, then the trustee will be considered as the representative assessor. Now, in the case of the trust, section 161, which talks about the specific trust, it says that the liability of a representative assessee as regards the income of the trust, he is subject to the same duties, responsibilities, and liabilities as if the income is received by him. So he has to pay the taxes accordingly, and the income will be levied upon and recovered from him in the like manner and to the same extent as it would have been recovered from the trust itself. Are we clear? So if the PGBP is there, then the tax shall be charged on the income at the rate of the maximum marginal rate. Are we clear? At the rate of the maximum marginal rate. So just write down. This is maximum marginal rate. However, there is exception to that. So the exception is basically where the trust is for the benefit of the relative. For the benefit of the relative. Then it shall not be taxable at the maximum marginal rate. Okay, if the trust is for the benefit of the relative, then it will be taxable as per the slab rates. Then in this case, the slab rates. Now, if it is a discretionary trust, the taxability of that is covered under 164. So if there is no business income again, this is under section 164. Again, if no business income, then this is taxable at MMR, maximum marginal rate. Discretionary meaning where the shares of the beneficiaries are not known. Again, here the exception lies that where none of the beneficiaries have income greater than basic exemption limit. And it is a trust which is declared under the will, or it is a trust which is created for the employees. Then in that case, it will be taxed like the AOP. Then it shall be taxed like the AOP. So you can write over here. This shall be taxable at MMR. This shall be taxable at MMR. Exception. None of the beneficiaries have any other income. No beneficiary has other income greater than the basic exemption limit. Okay? And it is beneficiary only in one trust and not more than one trust. Secondly, the trust is declared under the will, or it is a trust created under the will. Okay? Or it is a trust for the employees, which is basically the EPF and all of that. Which is EPF, etc. In these cases, the income of the trust will be taxable like AOP. Taxable like AOP. So if it is no business income, then you will identify where the shares of the members are unknown, then it will be taxable at the maximum marginal rate. So this will be taxable again at maximum marginal rate, but it will be taxed like the AOP. Are we clear? Then if there are business income, if there is business income, again it shall be taxable at the MMR. This shall be taxable as the MMR. But in case where there is a business income, in that particular case, again, you need to see what will be the maximum marginal rate. So in case the beneficiaries are unknown, in case the beneficiaries are unknown, the shares of the beneficiaries are not determinate, then in that particular case where there is, let's say, business income also, then it will be taxable at the MMR. Okay? Yes or no? Any questions, any doubt till now? Yes or no? Fine. Here also, again, there is an exception. The exception is that if the trust is declared by will or it is for the dependent relative, again, here there's an exception. Trust created by will for benefit of relative, or it is only trust of settler, then this shall be taxable at the slab rates. Okay, so this shall be taxable at the slab rate. So where any income in respect of a trustee, in respect of a trust, then if it is a business income, then in that particular case, it shall be basically determinable as per the slab rate. Are we clear? Okay. Now here, understand one thing. This shall be taxable in the hands of a trustee as the representative assessee. Fine. Any questions? Any doubt? Yes, students. Okay, now I'll just once more explain. There was one doubt which was raised with regard to the mutuality concept. I'll just once again explain it before we close the session. So as I said, for the concept of mutuality, there are two things. One is the general income, like entrance fees, transfer fees, right? Or membership charges. So whatever income is there, this is not taxable on the concept of mutuality, and the expense will also be not allowed. However, if there is deficiency, then this will be allowed under section 44A, which will be half of the total income. This will be the half of the total income. Now, in case of the specific charges which are there, just write down. Sorry, 1 second. I think there's some issue. Yeah. In case of the specific charges which are there, the specific charges are taxable in the hands of the as the PGBP. So specific activity, if it is carried out, not the general income. You can just write general activity, specific activity. So PGBP. Under which section? Under section 28. 28.3. So under section 28.3. This is income minus the expense. Are we clear about the mutuality? Yes. And any interest on surplus funds not covered by the principle of mutuality. So you can just write it over here. Interest on surplus funds not covered by mutuality. Madras Gymkhana case. Madras High Court. Okay, and then transfer fees, membership charges are governed by the principle of mutuality. This is as per the Venkatesh. This is as per the judgment of the Supreme Court in the case of Venkatesh Premises Cooperative Society. Fine. Yes or no? Any doubt before we close? So we have done the private trust as well. Now what is remaining is charitable trust, the political parties and the REIT. In the next class, we'll start with the REITs, then we will move on to the political parties, and then finally we will dedicate the next class and the day after that solely on the charitable trust, which is very, very, very important. And the REIT is also very important. Okay. So be present, just revise whatever we have done. These are small, small topics, but please revise and let's meet in the next class. Okay. So thank you so much. We can close the session.